What is going on, investors? Hopefully you guys are doing well out there. It is time to talk about Affirm, ticker symbol AFRM. If you own this stock, you are not feeling good in the after hours. During the regular session, stock was down 21%. In the post market, we're down another 3.87%. We'll talk about this from a technical perspective. Is this right? Back in November, this stock was up over $170 per share. Now we're all the way down here, closer to $56 per share. We'll talk about, is this a buy the dip opportunity considering this tremendous drop? And not only that, it looks like you have an area of support down here at about $50. We'll talk about that from a technical perspective later on in the show. But let's talk about these Q2 numbers. This is what's driving the action in the stock in the after hours. Revenues came in at $361 million. That was good for 77% year-over-year growth. That did beat the expectation on that revenue side by about $28 million. Gross merchandise volume, this is essentially the amount of money that flows to Affirm from consumers. They distribute most of that actually to manufacturers and websites and product owners on websites. Affirm only retains a small portion of this gross merchandise volume, or GMV, in the form of revenue. So revenue was $361. That's what the company can recognize. But they want to point out that $4.5 billion in the most recent quarter was spent through Affirm, which is certainly a strong metric that this company has. And that was up 115% year over year. The other thing that the company noted was active merchants accounts, essentially websites that are accepting Affirm. That went from 8,000 up to 168,000, driven primarily the fact that Shopify essentially integrated Affirm into all of their payment options. Active customers grew 150% to 11.2 million, and that is an increase of 2.5 million or 29% compared to just quarter over quarter. This is a company that's expanding rapidly in their customer base. The reason why we keep a close eye likely on this customer base is the fact that transactions per active consumer increased 15% to 2.5. So as they bring on a customer, it's actually pretty high likelihood that they end up using Affirm more than once. That's certainly good for the company. And we'll talk about that from a marketing spend as well with Affirm. They spend a ton of money on marketing, but you have to be comfortable with the fact that that may pay off in subsequent quarters when those consumers that join this month happen to use the service later on as well. Now, they gave guidance for the upcoming quarter. GMV, or that gross merchandise value, expected to come in between 3.61 billion all the way up to 3.71 billion. I talked about how they just did a quarter of 4.5 billion, but keep in mind that 4.5 billion is a holiday period. It was over Christmas, and so you'd expect a little bit higher spending on that side. Now, revenues are expected to become 325 million all the way up to 335. That's the guidance range. Consensus was basically smack dab, actually under that a little bit, at $332 million. So they actually came over consensus on that revenue estimates. I talked about how in the most recent quarter, they had revenues of 361. The upcoming quarter, we should be in that 330 range. They also gave us full year guidance over at Affirm, which is interesting that they have this much visibility into the full year. Gross merchandise value expected to become $14.5 billion all the way up to $14.78 billion. Revenue is expected to be between 1.29 and 1.31. Expectations were just slightly under the low end at 1.28 billion. So they came in the most recent quarter a little bit higher on that revenue side, and for the full year on that revenue side, but it's clearly not impressing investors, because if you annualize out this revenue number of 361, you're not far underneath the revenue guidance they gave for the full year. So I think investors basically have great visibility in the upcoming year, and they're not super excited about it. On top of that, you got an $18.3 billion market cap on a company that's doing revenues south of $2 billion. On top of that, they're wildly, and you'll see it here in a second when we get to the financials, wildly unprofitable as well. I think that's what has investors pulling back on this stock, certainly over the last couple of months. We've got the 3 months ended here. Left-hand column is our most recent quarter. 6 months ended. The second column on the left is actually our most recent year on a 6-month basis. Let's run through these revenues. So we have these revenues coming at $3.61 million. We showed it to you here. That was 77% growth over the previous quarter, which was $204 million on a yearly basis. Year over year, you went from 378 up to 630. Look, strong revenue growth. You got a big multiple on this one. Okay, not from a price to earnings, because it's essentially affinity. When we come down here to net income, this company is losing quite a bit of money, both on a quarterly basis and a yearly basis, but even on a sales basis, okay, $1.3 billion worth of sale, $19 billion worth of revenue. Pretty hefty price to sales multiple, quite frankly, okay? Now we come to look at these expenses, and those ballooned in the most recent quarter. You went from 230 all the way up to 557. So we grew our revenues by about 160 million. You went from 204 up to 361. Well, you grew your expenses by like $320 million. And where did a lot of it go? Is actually sales and marketing. Take a look at this. You had $40 million in sales and marketing last year on a quarterly basis. That went up by over $100 million to $143 million. So I'll repeat this. You grew your top line revenues by 160. You grew your marketing budget, let alone everything else, just your marketing budget by $100 million. So you guessed it. You take this 361, you minus off your cost of 557, and you lost $196 million just in the most recent quarter. You see last year, you lost 26 million. You see for the 6 months, these losses are accelerating because for 6 months, you lost 362. This company is on pace to burn through a lot of money over the next 6 to 12 months and probably even 24 months. That is also going to keep a lid on the stock because as we get to cash flows, we'll see this company is doing a lot of fundraising and some of it happens to be diluted, although maybe not necessarily right in the beginning. Some of that convertible note will likely convert into dilutional shares at some point. You see, year over year, I know this company just recently went public, so it makes sense that the share count went up by this much, but this is likely something that will continue, not necessarily at this pace, but we're likely to see dilution continue with this company as they're going to need to raise more and more money as they burn through just a large amount of cash. Take a look at the 3 months ended on the cash flows. I don't know if cash flows is the best way to analyze this company because this is really going to paint a really ugly picture. You lost 159 on that net income side. You get to add back some things. Stock-based compensation is massive at this company, $88 million. You factor that into when you look at these expenses, a fair amount of it or some of it is stock-based compensation. In fact, they show it to you here, okay? 88 million of this 557 is actually stock-based compensation. So this is not all cash burning out of the company, but even if you take off 88 million off of 557, this company is still losing money on a cash basis. And you come back through, you add back things, you subtract some things, you get all the way down here, it paints a terrible story. Net cash used in operating activities is negative by $440 million over the last 6 months. It was $75 million, really bad. But I think with companies like this, there's some funky accounting that happens in these cash flows. Wouldn't necessarily analyze this from a $440 million worth of negative cash flows. It's a little funky the way it works out. Really what we want to come down here and look at in the most recent quarter, they issued this convertible debt from $1.7 billion, proceeds from the funding debt, another $800 million. They paid some principal on some funding debt as well at about $653. All things being considered, this company is in fundraising mode. And when you zoom up here to the balance sheet, a lot of it is sitting up here in cash. You got about $2.5 billion. You got a little bit more in restricted. These loans held for investment are essentially the loans that this company has already loaned out to customers. The other thing that we saw with this company is the allowances for credit losses. Obviously, when you issue more loans, you have to set aside a little bit more money for certain consumers that are not going to pay back on those loans. All things being considered, about what you'd expect with this company. You did add this $1.7 billion on the liability side in that convertible note. We'll see how that converts in the future. Could be dilutive. Now, moving over to a technical perspective with Affirm, it's really simple to see that we are in a mega downtrend. Now, if we tried to reverse in the shorter term, really shorter term, and we were talking about like over the last week or so, the stock actually found a technical bounce down here at $49 per share, but we saw that there is an area of resistance not far above at $67. Now, it did put a candle up above it and tried to put another candle up above it today, but it got rejected pretty quick. We are still in a steady and steep downtrend on this one. Could you buy this if you wanted to? Down here at about $50 per share, which are the lows that it's bounced off several times since going public just not too long ago. Sure, you could buy it down here at $50 per share. If I did, not if I did, I absolutely would put a stop loss very shortly underneath that, maybe $48, maybe $47, because who knows how low this stock can go. if you break this $50 level. That is your downside. Unfortunately, I think your upside is simply just back up into this area of resistance up here at $65. So if you want to play the bounce from 50 up to 65 or 60-ish, you can, but I think that's a risky bet, okay? This isn't really a value stock. This stock is also in a downtrend. If I'm going to play bounces, I'd rather play it in a stock that's in a longer term uptrend, okay? We looked at other stocks today like Coke, okay? We could play the bounce in a stock like that. This stock is in a longer term uptrend, okay? We could play bounces there. We also looked at Pepsi earlier today. I'm not necessarily comparing these companies, okay? Affirm to Pepsi and all this stuff. It doesn't make any sense. But look, I'd rather play a bounce on a technical chart like this where it pulls back to the bottom of the range and we expect a bounce up, whereas Affirm, we are in this big downtrend, and yeah, you can buy it down here at $50, but I don't necessarily think you've got a lot of upside in this one. Personally, if you like Affirm, and I do, I don't want to make it seem like I don't like this company. I like this company's products. I've used this company's products because they offer me no interest on a number of different purchases I've made, so it costs me absolutely no money to use this company's products. I think that is fantastic. I like what this company has going on, but what I see here is this company is losing a ton of money because there's probably a lot of consumers out there like me that are basically using this company's service for free. So whether they make money on me down the road, we'll see. There's also a lot of competition in this space. I would click follow or put this stock on your watch list, monitor it for a while. You're looking for a breakout well above $70 per share. I think you really need to get above this cluster of highs here at about $80 per share until you can assume that this downtrend is over. I don't think that's going to happen anytime soon. This company gave you very clear guidance, not only into the next quarter, but this upcoming year. And it's not super impressive. Honestly, from a year-over-year perspective, it will look impressive. But I think a lot of people were assuming this company was growing a little bit faster than it was. And so I think this company will be stalled out for the shorter term. That was Affirm Holdings. Hopefully you guys enjoyed this video. I'll be back again soon with more. Good luck with your investments.